What if I told you that every single day millions of dollars move in and out of the market, and most beginners have no clue they could claim a piece of it without earning a single share? That's the wild truth about options trading. It's not some secret game for Wall Street pros. It's a strategy you can learn, master, and profit from starting today. But here's the catch. Most people who try fail. Not because they're not smart enough, but because no one ever simplified it for them. And that's where Woodley Fontanilla's book comes in, Options Trading Simplified for Beginners. Today, we're breaking it down, chapter by chapter, turning confusion into confidence. Buckle up. By the end of this deep dive, you'll see the market differently.
Hello, everyone. Hi, all, and welcome to Book Podcast Again, Zon.
I'm Emma.
And I'm John.
And I've always viewed options as this opaque financial tower, almost deliberately built, to keep retail investors like me out. But I'm definitely ready to try and scale it today.
And Emma, that opacity you mentioned, that's exactly what Fontanilla tackles head-on in this book. Our mission today, really, is to go beyond just the surface level. We want to extract the absolute core concepts of options trading using Fontanilla's simplified approach as our guide. We really want to empower you, the learner listening in, to understand these incredibly flexible tools, not as complex gambles, which is the common misconception,
Right.
but more as instruments. Tools for defining risk, managing risk, without all that anxiety that usually comes from, impenetrable jargon.
Yeah, because when I first hear options, my brain immediately jumps to risky derivatives, complex, scary. And I think that fear for a lot of people probably stems from just not really understanding what it is we're actually trading. It feels abstract.
Precisely. And Fontanilla does a great job of shifting that perspective. He helps you realize the fundamental thing you're trading isn't the stock itself, not directly. It's more like temporary time-bound leverage, legal leverage over that stock.
Like leverage, but
Yeah.
temporary.
Exactly. So we move past these confusing, kind of opaque contracts to the really essential realization. You are acquiring the right, but crucially, not the obligation to either buy or sell the underlying asset.
Right, not the obligation. That feels like the core
It
difference.
changes everything. Because think about it, that structure, that difference, it allows you to potentially cap your maximum downside loss right from the start. You know exactly what's at stake.
Okay.
But, and this is the exciting part for many, it leaves your potential profit structurally unlimited, at least on paper when buying options. That philosophical shift is massive.
Right, shifting from maybe pure stock risk to defined risk. Okay, I'm ready. Let's dive into chapter 1. Okay, let's really unpack this crucial first step. Fontanilla kicks off chapter 1 by framing options. Well, not as that high-stakes gamble we just talked about.
Yeah.
Instead, he presents them as these essential financial tools that can act like insurance policies for your investments. That makes intuitive sense. Or they can be bold, leveraged wagers on price swings. So two very different uses right there.
Exactly. And that reframing is, I think, the most important initial shift the book tries to instill. It's about moving the beginner from that state of confusion, maybe even fear, straight into a feeling of empowerment. Like, okay, I can use these.
Yeah, understanding the purpose first.
And the comparison he makes to traditional stock ownership is absolutely key here. It highlights the difference. Think about it. If you buy, say, 100 shares of a stock, you're a shareholder, right? You own a piece of the company. You are essentially obligated to ride that entire price roller coaster up and down.
For better or worse.
For better or worse. But an option contract, it's fundamentally different. It operates in a sort of parallel market, a market for the potential of future movement. An option grants the holder the right, there's that word again, the right to transact 100 shares of the underlying asset.
Usually 100 shares, right?
Typically, yes. In the U.S. market, one equity option contract controls 100 shares. So the right to transact those shares at a specific price, that's called the strike price, and you can do that anytime before a set expiration date. But the key word, the absolute core, is right. You only follow through. You only exercise that right if it actually benefits you. If it doesn't, you just let it expire.
Okay. Let's make that concrete. Say I buy 100 shares of, I don't know, big pharma company. Let's say Pfizer, stock symbol PFE. I buy it at $30 a share. That's $3,000 invested. If PFE drops to $20, well, I've lost a third of my investment, $1,000 gone, just like that. I'm stuck holding it unless I sell at a loss.
Right. You bear the full brunt of that downward move.
But if instead I bought an option contract, maybe a call option hoping it goes up, or a put option if I was worried it might drop. Let's say I just bought a contract for a small premium, maybe $100 total. Now, if the stock collapses from $30 down to $20, the most I can possibly lose is that $100 premium I paid.
That's it. Exactly. Your risk is defined and limited to the cost of the contract itself.
That flexibility,
Yeah.
that's got to be the core selling point, isn't it? Knowing your worst-case loss up front.
It absolutely is. And this fundamental distinction brings us directly to the two foundational contract types that really define the entire options market: call options and put options.
Okay, let's start with the one that probably gets most people excited first. The directional bet on prices going up, call options.
Right. A call option is essentially a bullish contract. You're making a bet, placing a wager, that the price of the underlying asset is going to increase. You purchase a call when you anticipate or hope that the asset will rise substantially above the strike price, and do so before that expiration date arrives.
So time is a factor too.
Oh, absolutely. Time is a huge factor. We'll get more into that later. But let's take a common U.S. example. Think about the S&P 500 ETF, symbol SPY. It tracked the whole market, basically. Let's say SPY is currently trading around $500 per share. You think the market's going higher in the next month. So you might buy a call option with, say, a $510 strike price that expires in 1 month. Maybe that contract costs you $3 per share, which translates to $300 total. Because remember, one contract controls 100 shares.
Okay, so $300 invested, betting SPY goes above $510 within a month.
Precisely. Your break-even point is actually the strike price plus the premium paid. So $510 plus $3 means SPY needs to get above $513 by expiration just for you to break even.
Ah, okay, so it needs to move quite a bit just to not lose money.
Correct. Options aren't free money, but now let's look at the upside. What if the market really takes off? Let's say SPY surges to $520 before your option expires.
Okay.
Now your option, the one with the $510 strike, is $10 in the money. Why? Because you have the right to buy 100 shares of SPY at $510, even though the market price is $520.
So you could theoretically buy at $510 and immediately sell at $520 for a $10 profit per share.
Exactly. Or, more likely, you just sell the option contract itself. That contract, which you bought for $300, is now worth at least $1,000, the $10 per share intrinsic value times 100 shares. It might be worth even more due to remaining time value, which we'll discuss.
Wow, so a $700 profit on a $300 investment. That's significant leverage.
That is the power and the allure of options leverage. You controlled the profit potential of $51,000 worth of SPY stock movement for just a $300 capital exposure, risking $300 to potentially make multiples of that.
Okay, that makes the appeal very clear. Now, conversely, let's talk about the other side, put options. These feel more like the safety net, or maybe a bet on things going down.
Both, actually.
Yep.
Puts are generally considered bearish instruments, but they have this really interesting dual utility that Fontanilla explains well. First, yes, they are the shielding mechanism, the insurance policy. Let's say you already own 100 shares of a big tech stock, maybe Apple, AAPL, and you're worried about an upcoming earnings report or just a market correction.
You don't want to sell, but you're nervous.
Exactly. You buy a put option. This gives you the right to sell your 100 shares at the strike price, no matter how low the actual market price drops. So it effectively puts a floor under your potential losses on that stock holding. It protects your capital from a catastrophic drop.
Okay, so that's the insurance use case. What's the other one?
The second use is purely speculative. You don't need to own the stock at all. You simply buy a put option if you believe the underlying asset's price is going to fall. If the stock price drops below the strike price, minus the premium you paid for the put, you start making a profit. Why? Because the put gives you the right to sell shares at the higher strike price, shares you can theoretically buy cheaper in the open market, or more practically, you just sell the put contract itself for a profit as its value increases when the stock price falls.
So, calls for upside bets, puts for downside bets or protection, seems straightforward enough at the core.
At the core, yes. The complexity comes later, but that's the foundation.
Now, Fontanilla includes some really interesting extra context in the book talking about real-world market volatility. He specifically notes how those massive, sometimes really rapid surges we've seen in U.S. tech stocks and indices. He gives the example of the QQQ ETF, which tracks the NASDAQ Q100.
Right, heavily weighted towards tech and growth.
How those surges have made call options almost the default go-to tool for aggressive traders looking for quick gains.
And that observation ties directly back to that leverage point we just discussed. It's because of the non-linear returns possible with options. The potential payoff isn't just one-to-one, like owning stock.
Nonlinear, meaning a small move in the stock can cause a huge percentage move in the option price.
Precisely. If the QQQ, representing all those major U.S. growth and tech companies, goes on, say, a 5% run over the course of a month, which isn't uncommon,
Yeah, we've seen that happen.
that seemingly modest 5% move in the underlying ETF could potentially cause an appropriately chosen call option contract to increase in value by, I don't know, 200%, 300%, maybe even more, depending on the strike price and time to expiration.
Wow.
This perfectly illustrates that high-reward nature that definitely attracts people to options. But, and this is the crucial part Fontania emphasizes, it also demonstrates why understanding the flip side, the risk of that entire premium you paid potentially disappearing, going to zero if you're wrong about the direction or timing, is absolutely critical. High reward often comes with high risk, if not managed.
So wrapping up Chapter 1 then.
Yeah.
The main goal seems to be realizing that options aren't just weird, complex derivatives. They're actual usable strategies. They offer leverage, they offer protection, and the most critical piece of understanding is that concept of having the right, but not the obligation.
Exactly. It's about seeing them as instruments that let you define your financial posture, your bet on the future, or your need for protection in a very specific way.
Moving beyond just the textbook definition of the derivative contract.
And realizing you're essentially defining future potential or insuring against future loss, all for a predetermined upfront cost the premium. That's the mindset shift.
Got it. That sets a really solid foundation. Like, subscribe, and share for more update and continue to next. Okay, so if Chapter 1 was about the what options are, Chapter 2 really dives into the why. Specifically, why does one option contract cost, say, $100, while another seemingly identical contract, maybe on the same stock but a different strike or expiration, costs $1,000? We're talking about the price tag now, the premium. And honestly, for a beginner, this is often where the eyes start to glaze over. It feels complicated.
It can definitely feel that way, and Fontania tackles this directly. He does it by deconstructing the premium that cost you pay up front to enter the contract into its two main components. You really need to sort of deep dive into the structure to understand what you're actually paying for. Those two components are intrinsic value and extrinsic value.
Okay, let's try and start with what sounds like the easier part. Intrinsic value. What is that?
Intrinsic value is actually quite straightforward. It's the real, tangible, immediate profit potential that an option possesses right now. It only exists if the option is currently in the money.
In the money, meaning it would be profitable if exercised immediately.
Exactly. So for a call option, let's revisit that SPY example. Stock is trading at $520. If you hold a call option with a $510 strike price, it has $10 of intrinsic value per share. $520 current price, $510 strike price. Because you could exercise it right now and capture that $10 difference.
Okay. For the put option.
Same logic, just reversed. If the stock is trading at $490 and you hold a put option with a $500 strike price, that put has $10 of intrinsic value. $500 strike price, $490 current price. Because you have the right to sell at $500 when the market is only $490.
So intrinsic value is the real part of the premium based on the current market price versus the strike price.
Correct. And options that have significant intrinsic value, often called deep in the money options, are generally considered much safer in a sense because a substantial portion of their price, their premium, is based on this realized current value, not just future hope.
Okay, that makes sense.
Yeah.
For the part that feels more abstract, maybe more dynamic, and definitely more exciting, extrinsic value.
Right. Extrinsic value is essentially everything else that makes up the premium besides the intrinsic value. It's the component of the price that's based purely on the expectation or the possibility of future favorable movement. It's the speculative part, you could say.
The hope part.
You could call it the hope part or the potential part. Fontania breaks this down into two massive drivers: time value and volatility.
Okay, time value first. That sounds like it relates to the expiration date.
Precisely. Time value is probably the simplest concept conceptually, though its effect is profound. Every single day that passes, the extrinsic value of an option decreases, assuming all else stays equal. Why?
Because there's less time for the stock to make the move you needed to make.
Exactly. The probability of the stock moving favorably diminishes as you get closer and closer to that expiration date. There's just less opportunity. This steady erosion of extrinsic value due to the passage of time, it has a name. It's known mathematically as theta decay.
Theta decay. Okay, I've heard that term. It sounds ominous for option buyers.
It is. Theta decay is the option buyer's constant, relentless enemy. It's like a melting ice cube. The value is just dripping away every day. But it's the option seller's best friend because they collect the premium upfront and benefit from this decay if the option doesn't move into the money.
Ah, interesting. So selling options is a strategy too. We'll get to that later, I guess.
We will. But for now, just know time is constantly working against the buyer of an option due to theta.
Okay. So that's time value. What's the other big driver of extrinsic value? You said volatility.
Volatility, and specifically its implied volatility. This is the market's collective expectation, its best guess, about how wildly the underlying stock's price is likely to swing between now and the option's expiration. It's quantified by another Greek letter, vega.
So not how much it has swung, but how much the market thinks it will swing.
Exactly. Think about a specific U.S. example. Let's say a major semiconductor company like NVIDIA is due to report earnings next week. Earnings reports are notorious for causing big price jumps or drops.
Always a lot of anticipation.
Right. So in the days leading up to that earnings report, the market expects a big potential price swing. That expectation gets baked into the option prices. The implied volatility will surge. Consequently, the extrinsic value component of both call options and put options on NVDA will balloon. They become more expensive. Why? Because the potential for a massive move in either direction is suddenly amplified.
So you're essentially paying a higher potential drama premium, or maybe a higher insurance cost because the perceived risk of a big move is greater.
That's a great way to put it. Higher implied volatility means higher extrinsic value, which means a higher overall premium for the option buyer. People are willing to pay more for the chance to capture a potentially huge move or to get protection against one.
This brings us neatly back to those out-of-the-money OTM options you mentioned earlier. Fontania seems to suggest the emotional stakes are highest with these. Why is that?
Because an OTM option, by definition, has zero intrinsic value. None. If the stock price is $100 and you're looking at a call option with a $120 strike price, it's $20 OTM. It has no immediate realizable value.
So its entire premium, whatever it costs, is purely extrinsic value.
Pure extrinsic value. It's trading purely on hope, on future potential, on time value, and implied volatility.
Okay.
Now, these OTM options are usually the cheapest contracts to buy in absolute dollar terms. That makes them seem very attractive, especially to beginners. They offer incredible leverage if they work out.
Right, like that SPY example, low cost, big potential payout.
But they require the highest level of conviction and luck, perhaps, because the underlying stock has to move quickly and substantially just to get to the strike price, let alone past the strike price plus the premium paid before expiration hits.
So using that $100 stock, $120 strike call example, the stock needs to move more than $20 plus whatever premium I paid just to break even.
Yeah.
It has to do it before the expiration date.
Correct. If it doesn't make that significant move in time, poof, that entire premium you paid is completely lost, gone to zero. That's why the stakes feel high, cheap entry, but total loss is very possible, even likely sometimes.
Okay, but here's a question then. If I have really high conviction, if I'm sure the stock is going to hit $120 or more, why wouldn't I just buy that cheaper OTM option for maximum leverage? Isn't that the smart play? It feels like it should be.
And that is the classic beginner's trap. It seems logical, right? Maximize your potential return. But Fontania addresses this exact thinking, and the way he explains it is through introducing the Greeks. Because while the potential leverage on that cheap OTM option is higher, the probability of it actually paying off is significantly lower. And remember, theta. Time decay hits those purely extrinsic OTM options the hardest. Their value melts away fastest.
Okay, so it's a trade-off between leverage and probability and time decay.
Precisely. And to really understand and quantify that trade-off, you absolutely need the Greeks. Fontania introduces them as metrics that help you track these various risks and characteristics. We've mentioned theta, time decay, and vega, volatility sensitivity. But the first and arguably most critical Greek metric, especially for beginners, is delta.
Okay, delta. What does delta tell us?
Delta is fundamentally about sensitivity and leverage, but it also gives you a rough idea of probability. At its most basic level, delta tells you how much the options price, the premium, is expected to change for every $1 movement in the underlying asset's price.
Okay, so it's like a responsiveness score.
Exactly. Think of it like that. Delta values for call options range from 0 to 10. For put options, they range from 0 to $1.00. An option that's deep in the money might have a delta close to $1.00 for calls, or magus $1.00 for puts. This means its price will move almost dollar for dollar with the underlying stock. An option that's at the money, strike price is very close to the current stock price, typically has a delta around 0.50 or minus 0.50 for puts. And those OTM options we were just talking about, they have low deltas, maybe 0.20, 0.15, or even lower the further out they are.
So let's connect that back. If I buy that cheap OTM call, the one with the $120 strike when the stock is $100, maybe it has a delta of only 0.15. If the stock then moves up by $1 from $100 to $101, my options premium only increases by about $1.15 per share, or $15 total on the contract.
That's roughly correct, yes. All else being equal.
Okay, so if I spent, say, $50 total on that premium, 50 cents per share, the stock has to move up several dollars just for the delta gains to start covering the cost. And that's before considering the time decay that's constantly eating away at the premium, too.
Exactly. You see the problem. That cheap OTM option requires a truly Herculean effort from the underlying stock just to break even, let alone make a significant profit. The low delta means it participates much less in the stock's gains initially, and theta is working against it constantly.
Wow, okay. Misjudging delta seems like a really easy way for beginners to lose money then, buying cheap lottery tickets without realizing how unlikely they are to pay off.
It is probably the primary way beginners fail, according to Fontanilla and many others. They get seduced by the low price and high potential leverage of OTM options, but they fail to appreciate how low the delta is and how much the stock actually needs to move against the drag of time decay. Fontanilla really uses delta to illustrate this crucial balancing act for beginners. You generally pay more premium for options that have higher delta, meaning they are closer to the money or already in the money. Why?
Because they're more likely to be profitable?
They have a higher probability of finishing in the money, yes. But also, crucially, they are less sensitive to the damaging effects of time decay. Their theta value is lower. And they are more responsive to favorable moves in the underlying stock price. Their delta is higher. You get more bang for your buck when the stock moves your way.
So you pay more for higher probability and better responsiveness? Less for a long shot?
Generally, yes. There's no free lunch, but delta gives you a way to quantify that trade-off. Fontanilla also points out another fascinating aspect of delta. It can be used as a rough proxy for the implied probability of an option expiring in the money.
Really? How does that work?
Well, very roughly speaking, a call option with a delta of 0.50 is seen by the market as having about a 50% chance of expiring in the money. A call with a delta of 0.20, maybe around a 20% chance. It's not perfect, but it gives you a quick gut check on how likely the market thinks your bet is.
That's actually really useful. So delta isn't just about price sensitivity, it's also a hint about probability.
It packs a lot of information into one number.
Now, Fontanilla connects all this, especially volatility and the Greeks, directly to what he calls the fast-paced 2025 markets. He notes that things like AI-driven predictions seem to be making volatility almost instantaneous now.
Absolutely. Think about how quickly news travels and how fast algorithmic trading reacts. Volatility doesn't just gradually build anymore. It can spike or collapse almost instantly based on new data inputs, maybe an AI model flagging a previously unnoticed correlation or risk factor. This makes understanding these Greek indicators feel more alive than ever, as Fontanilla puts it. If, for example, some AI analysis suddenly predicts a higher chance of legislative change affecting a major U.S. industrial stock, like maybe Caterpillar, CAT,
Okay.
you could see the implied volatility, vega, and thus the extrinsic value of sawed-out options adjust almost immediately. The delta might also shift as the market recalculates probabilities. You need to understand what these Greeks are telling you in real time.
So using delta helps you understand if you're buying something that's highly leveraged but needs a huge move, that low delta OTM option, or something maybe safer that moves more closely with the stock but costs more, the high delta ITM option.
Precisely. Making that constant calculation, understanding that trade-off between cost, leverage, probability, time decay, and volatility sensitivity. That's the difference between making an informed decision and just placing a blind bet. Chapter 2 is really about giving you the tools, the concepts of premium components, and the Greeks like delta to start making those informed decisions.
It's like needing to understand how your car handles, how sensitive the steering is, delta, how fast it burns fuel just sitting there, theta, how much the suspension reacts to bumps, vega, before you take it out on the racetrack.
That's a fantastic analogy. Exactly right. You need to know how your vehicle, your option position is likely to behave under different road conditions, market movements.
Okay, this chapter feels dense, but incredibly important. Understanding the cost and the risks through the Greeks. Like, subscribe, and share for more update, and continue to next. All right, Chapter 3 feels like where we get to the real core confidence builder for potential options traders. Fontanilla pivots here to directly address that internal conflict most beginners probably feel, that mix of fear and ambition. On one hand, there's the excitement, the adrenaline rush Fontanilla acknowledges, a potentially unlimited profit potential with something like a long call. But on the other hand, there's the fear of losing everything. And this chapter seems to resolve that conflict by highlighting the incredible safety net, knowing your maximum loss is strictly capped at the premium paid.
This concept of defined risk is, without a doubt, the absolute foundation of responsible options trading, especially for beginners. It's probably the single biggest differentiator compared to just buying stock outright. Think back to that Pfizer example. If you buy the stock and it goes to zero, you lose 100% of your investment. The risk is theoretically total loss of capital.
Right. Scary.
But with a long option position, which means simply buying a call or buying a put, your risk is absolutely defined from the moment you enter the trade. You are only risking the premium you paid. That premium is non-refundable, yes, but that's the maximum you can possibly lose on that specific trade.
That knowledge must provide a huge amount of confidence, right? It means you can allocate capital more strategically, maybe take more calculated shots, because you know exactly what the worst-case scenario is before you even click the buy button.
It absolutely does. It shifts the psychology from hoping the bottom isn't zero to knowing precisely where your risk ends. Let's look specifically at the risk profile of the long call again. Say you buy a call option on an exciting, maybe speculative asset. Let's pick a hypothetical pioneering electric truck stock, maybe one trying to compete with Tesla or Rivian. You pay $500 for one call contract because you think their new model is going to be a huge hit.
Okay, $500 risk.
If you're right and the stock truly takes off, maybe it doubles, triples, who knows? Your upside potential on that call option is genuinely, structurally boundless. As the stock climbs higher and higher above your strike price, your profit keeps increasing.
Unlimited potential upside.
Theoretically, yes. But what if you're wrong? What if the truck has battery issues, the company faces massive recalls, and the stock crashes and burns, maybe even goes bankrupt?
Then I lose.
You lose only the $500 premium you paid for that call option. That's it. Your loss is strictly, absolutely limited to the initial cost of the contract. $500 is your maximum pain point on that trade. Compare that to owning $10,000 worth of stock and watching it go to zero. Huge difference in risk profile.
Okay, the defined risk on a long call is clear. Now let's detail the risk profile for long puts, but really focus on their power as that downside protection, that insurance policy.
Right. The long put as insurance is a classic strategy, and Fontanilla provides some excellent context on why it's so valuable, particularly during times of economic stress or uncertainty. Let's imagine a slightly different scenario. Say you already own 500 shares of a U.S. regional banking stock. Banks can be highly cyclical, sensitive to interest rates. Let's say the stock is currently trading at $40 per share, so your total equity position is $20,000.
Okay, decent position. Then maybe you're getting nervous.
Exactly. Maybe you read Fontanilla's book, you hear chatter about the Federal Reserve potentially starting a new tightening cycle, raising interest rates, which could hurt bank profitability and maybe cause a sector downturn. You don't want to sell your shares. Maybe you think long-term they're good, but you want protection now.
So you want insurance against a potential drop. What do?
You buy long put contracts. Since each contract covers 100 shares, you'd buy 5 put contracts to cover your 500 shares. Let's say you choose a strike price slightly below the current price, maybe $35 to keep the cost down. And let's assume these puts expiring in maybe 3 months cost you a premium of $1 per share. So $1 times 500 shares means your total cost for this insurance policy is $500.
Okay, $500 spent for 3 months of protection below $35 a share.
Correct. Now, let's play out the bad scenario. The Fed confirms the tightening cycle, banks get hit hard, and your regional bank stock crashes down to, say, $25 per share.
Ouch. What happens to your $20,000 initial position if you didn't have the puts?
Without the puts, your 500 shares are now worth only $12,500. 500 shares x $2,500. That's a painful paper loss of $7,500. Your equity got hammered.
Okay, but with the put insurance.
Now things look very different. Those put options you bought give you the guaranteed right to sell your 500 shares at the $35 strike price, even though the market price is only $25.
So you exercise the puts.
You would, or more likely, the value of the puts themselves would skyrocket, and you could sell them for a large profit that offsets most of your stock losses. But let's think about the effective outcome on your stock. Your loss on the stock itself is effectively capped. You sell at $35 instead of $25. Your loss per share is the difference between your starting price $40, and your guaranteed sale price, $35, which is $5 per share. Plus, you have to account for the $1 per share premium you paid for the put insurance. So your total effective loss is $6 per share. $5 stock loss plus $1 premium cost.
Okay, $6 per share loss times 500 shares. That's a total loss of $3,000.
Correct. Now compare that $3,000 loss to the $7,500 loss you would have suffered without the puts. You effectively preserved $4,500 of your capital that would have otherwise evaporated in the crash.
Wow, that really demonstrates the power of puts for capital preservation, achieving those steady builds toward wealth Fontania talks about, not necessarily through huge gains, but by avoiding catastrophic losses.
Exactly. And this ties directly into the kind of volatile economic shifts we've seen in the real world, particularly post-2020. We had significant inflation waves, rapid sector rotations, lots of uncertainty.
Yeah, it felt like the market mood could change overnight.
In that kind of environment, options, especially puts, become incredibly valuable instruments of preservation. Fontania notes that smart investors, institutional and retail alike, likely utilized puts during those highly volatile periods to essentially lock in certain price floors for their core equity holdings.
So they didn't have to panic sell their long-term investments during a downturn.
Precisely. They could ride out the storm with more confidence, knowing their puts were absorbing a large part of the temporary shock, allowing them to maintain their strategic long-term positions. It's a sophisticated way to manage portfolio risk.
But Fontania emphasizes this strategy requires understanding a trade-off, right? It's not free protection.
Absolutely crucial point. There's always a trade-off. And the primary trade-off, the cost you pay for having this bounded risk, this insurance, is that relentless theta decay we talked about in Chapter 2.
The melting ice cube.
The melting ice cube.
Yeah.
That premium you paid for the call or the put, it's constantly losing value simply due to the passage of time. You are explicitly paying for safety for that defined risk profile, but that safety net has an expiration date.
So while long options give you this superb protection or leverage, you have to be right about the direction of the stock move.
Yes.
And you also have to be right about the timing before theta eats away your entire premium.
Exactly. If the stock moves your way, but only after your option is expired, it does you no good. If the stock just stays flat, theta will ensure your premium dwindles down to zero by expiration. That lost premium is essentially the cost of doing business when you're buying options. It's the price of that defined risk.
This really raises that critical question Fontania seems to pose for the learner, for you listening. When you truly internalize this controlled risk structure, the power to define your maximum loss up front before you even commit capital, how does that compare to simply buying and holding stock? What really stands out? For me, it feels like a fundamental shift, moving away from purely emotional investing, hoping things go up, towards a more calculated, almost mathematical approach to risk management.
I think that's exactly right. It's the peace of mind that comes from knowing the absolute boundaries of your downside, and paradoxically, that peace of mind might allow for bolder, yet still calculated decisions, because the worst-case scenario is known and accepted from the start. It's about controlling what you can control your maximum loss.
Defined risk. That seems to be the cornerstone of this chapter. Powerful stuff. Like, subscribe, and share for more update, and continue to next. Okay, Chapter 4 feels like a real turning point in the book. Fontania seems to be transitioning the reader, you the learner, from being just a passive observer who understands the definitions and the risks,
The foundational knowledge,
into becoming an active, strategic player. We're moving beyond just buying a single call or a single put and getting into actual techniques. Specifically, he introduces multi-leg strategies, focusing heavily on vertical spreads.
Yes, vertical spreads are absolutely pivotal. Fontania presents them as a kind of bridge for beginners to move into more sophisticated ways of trading options and managing risk. And he views them as particularly beginner-friendly precisely because they inherently enforce discipline.
Beginner-friendly but multi-leg. That sounds a bit counterintuitive. How does combining options make it easier or safer?
It sounds complex, but the structure actually simplifies the risk profile. A basic vertical spread involves two actions done simultaneously. You buy one option, a call or a put, and at the same time, you sell another option of the same type. So both calls or both puts. They're on the same underlying asset, like Apple stock. They have the same expiration date, but crucially, they have different strike prices.
Okay, buying one, selling another, same type, same expiration, different strikes. Why does doing both at once make it safer?
Two key reasons. First, remember how selling an option brings in premium. That income you receive from selling the second option immediately helps to reduce the overall cost of establishing the position. Sometimes it can even result in a net credit.
Ah, so it lowers your upfront cost, meaning less capital risk.
Exactly, less capital at risk. Second, and this is the really clever part, the difference between the two strike prices you chose creates a clearly defined risk and reward corridor. Your maximum possible profit and your maximum possible loss are both established and capped right from the outset.
Capped profit and capped loss.
Yes. Unlike a simple long call with unlimited potential profit, a spread limits your upside. But in return, it significantly limits your downside risk and reduces your entry cost. It aligns the trade perfectly with a specific measured market prediction rather than just a general, I think it's going up bet.
Okay, that makes more sense. Trading away unlimited upside for much more defined risk and lower cost. Let's break down the two primary directional spreads Fontanilla focuses on. First, the strategy for making a strategic upward bet, bull call spreads.
Right. A bull call spread is what you deploy when you are bullish. You anticipate a rise in the stock price, but maybe only a moderate rise. You don't necessarily expect the stock to go to the moon, just to move up steadily to a certain level. Let's use a real-world, highly traded U.S. stock example. How about Amazon, AMZN? Let's say Amazon is currently trading around $180 per share. You're moderately bullish. You think maybe it'll rise towards $190 or $195 in the next month or two, but you're not banking on it hitting $250.
Okay, moderate bullish outlook on Amazon at $180. How do you structure the bull call spread?
You'd structure it like this. You buy a call option with a strike price just above the current price, maybe the $185 strike call. Let's say that costs you $4 per share or $400 per contract. Simultaneously, you sell a call option with a higher strike price representing the top end of where you think the stock might go. Maybe you sell the $195 strike call. Let's say you receive $1.50 per share or $150 per contract for selling that one.
Okay, so buy the $185 call for $400, sell the $190 call for $150.
Correct. So, what's your net cost to enter this spread? You paid $400 but received $150. Your net premium paid, your total initial outlay, is $2.50 per share, or $250 per contract. Notice that's significantly cheaper than just buying the $185 call outright for $400.
Right, the sold call subsidized the bought call. Okay, so $250 is my maximum risk now.
Exactly. Your maximum possible loss on this bull call spread is precisely the net premium you paid. $2.50 per share or $250 per contract. If Amazon crashes or just stays below $185, that's the most you can lose.
And what's the maximum potential profit? You said that's capped too.
It is. Your maximum profit is determined by the difference between the two strike prices. $185 equals $10 minus the net premium you paid, $2.50. So $10 minus $2.50 equals $7.50 per share. Your maximum potential profit is $7.50 or $750 per contract.
So even if Amazon rockets up to $250, I still only make $750 on this spread.
That's correct. You capped your upside at $195 when you sold that call. But look at the trade-off. You risked $250 for a chance to make $750. That's a potential 3-to-1 reward-to-risk ratio achieved with significantly less capital outlay and defined risk compared to just buying the $185 call.
Okay, that numerical breakdown makes the discipline aspect very clear. You're explicitly trading away that unlimited profit potential for vastly reduced costs and clearly defined risk exposure. Feels much more controlled.
It is. It forces you to have a specific target price range in mind.
Now, let's look at the mirror image strategy Fontanilla presents, the one designed for expected downturns. Bear put spreads.
Right. Bear put spreads use the exact same logic, but with puts for when you expect a decline in the stock price. But again, probably a limited decline, not necessarily a crash to zero. You would buy a put option with a higher strike price, closer to the current price, and simultaneously sell a put option with a lower strike price, further out of the money.
So buy the more expensive put, sell the cheaper put.
Exactly. The put you buy gives you the right to sell at the higher strike if the stock falls. The put you sell obligates you to buy at the lower strike if the stock falls below that, which caps your profit potential if the stock absolutely tanks. But just like the bull call spread, the income you get from selling that lower strike put reduces your overall cost to enter the position. It limits your maximum loss if the stock unexpectedly rallies or stays flat, compared to just buying the higher strike put outright.
So again, defined risk, defined though lower reward, reduced cost, aligned with a specific bearish outlook.
Precisely. It's about tailoring the risk profile to match your specific forecast.
Fontanilla also briefly mentions the other two main vertical spreads, bull puts and bear calls, just to show the full spectrum available.
That's right, and they're important variations. A bull put spread, for instance, is actually a credit spread. You sell a higher strike put and buy a lower strike put. You receive a net premium upfront.
So you get paid to put the trade on.
Yes. And the bet here is essentially that the stock price will stay above the higher strike price, the one you sold, by expiration. If it does, both puts expire worthless, and you keep the entire premium you collected as profit.
Ah, so it's not necessarily betting on a rise, just betting it won't fall significantly.
Exactly. It's a strategy often used by traders who are mildly bullish or even neutral on a stock. They're looking to generate income by selling time premium while still having defined downside protection from the put they bought at the lower strike. It provides a potential income stream while limiting catastrophic loss if you're wrong.
Okay, so calls and puts, bought or sold, combined into these spreads. It really opens up a whole toolbox for expressing different market views with controlled risk.
That's the core insight of Chapter 4. You're moving beyond simple binary bets, up or down, and learning how to construct a position using multiple options legs that precisely maps to your specific market outlook and risk tolerance.
Now, Fontanilla ties this directly into the extra context he offers about the current trading environment, particularly accessibility. He talks about the boom in mobile trading apps, especially noticeable since around 2020. How has that changed things for strategies like spreads?
The democratization has been absolutely massive. Historically, executing multi-leg option spreads wasn't straightforward for retail traders. You often needed special broker permissions, maybe higher account minimums, and the platforms could be clunky. It was seen as more of a professional's game.
Right, it felt like you needed a Bloomberg terminal or something.
Almost, but now, any retail investor, pretty much anywhere in the U.S., using a standard commission-free brokerage app on their smartphone, think Robinhood, Webull, Schwab, Fidelity mobile apps, can execute a relatively complex strategy like a bull call spread or a bear put spread on a major asset like Microsoft, MSFT, or the QQQ in literal seconds.
That's incredible. The barrier to entry is just plummeted.
Completely. And Fontanilla links this trend back to what started maybe around the meme stock era. Remember GameStop, AMC?
Oh, yeah. Unforgettable.
That period really accelerated the process of retail investors rapidly absorbing and deploying increasingly sophisticated tactics. Information spread quickly online, communities formed, and suddenly concepts like spreads weren't just for Wall Street anymore. It feels like retail has genuinely democratized finance in that sense, making these once exclusive strategies commonplace.
So think about that U.S. example Fontanilla implies.
Yeah.
A beginner trader, maybe sitting in their living room in rural Nevada, can now execute a complex bear put spread on a major U.S. retail stock like Target, TGT, using their phone, with basically the same execution capability and speed as a professional trader sitting in a Chicago high-rise. The tools are universally available now.
The tools are there. Fontanilla's goal in this chapter is to provide the strategic map, the understanding of how and why to use these tools, specifically these spread structures.
And the core principle underlying that map seems to be, again, defined risk.
Always. Spreads inherently move the conversation away from pure, open-ended speculation towards calculated risk management. That's why they're such a crucial step for beginners looking to get more sophisticated.
Makes a lot of sense. Building complexity, but on a foundation of control. Like, subscribe, and share for more update, and continue to next. Okay, we've journeyed from understanding the basic contract in Chapter 1 to pricing it with REITs in Chapter 2, managing risk in Chapter 3, and deploying strategies like spreads in Chapter 4. Chapter 5 now seems to introduce a really crucial element of practical execution. Fontanilla shifts focus to what he calls the unsung hero of actual trading success: liquidity. This feels like where theory, like paper trading, smacks into the hard reality of the live market.
Absolutely. Fontanilla treats liquidity not just as a minor detail, but as potentially the difference between consistent success and constant struggle. Liquidity at its core is simply the ease with which you can enter or exit a trade at a fair price.
Ease and fair price. Oh.
If a specific option contract is highly liquid, it means there are lots of buyers and sellers actively quoting prices very close to each other. You can get in and out quickly, efficiently, without significantly moving the price against yourself. But if a contract is illiquid, well, that's where the problems start. You might find yourself unable to get out of a position when you want to. Or worse, you might be forced to accept a truly terrible price selling way below what you think it's worth, or buying way above just to complete the trade.
That sounds incredibly frustrating.
Yeah.
Fontanilla highlights an emotional pivot here. moving from that frustration over wide spreads to the satisfaction of efficient deals. I can imagine how infuriating it would be to have a winning trade idea, but then lose money just because the market for that specific option is too thin.
It's a silent killer of profits. When a market is illiquid, you often see a very wide gap between the highest price a buyer is currently willing to pay, the bid, and the lowest price a seller is currently demanding, the ask. That gap, the bid-ask spread, can instantly erode your potential profit before the underlying stock even moves.
Okay, let's make sure we define that bid-ask gap really clearly.
Right. Imagine you look up an option contract. The bid price might be $1. That's the best price someone is offering to buy it from you right now. The ask price might be a $1.50. That's the lowest price someone is offering to sell it to you right now.
Okay, bid $1, ask $1.50. That's a $1.50 gap.
Exactly. That $1.50 difference is the bid-ask spread. Now think about what happens if you want to buy this option. You'll likely have to pay the ask price, $1.50. But if you wanted to turn around and sell it immediately, the best price you could get is the bid price, $1.
So you instantly lose $1.50 or 33% of your purchase price just on the transaction cost.
Ouch, ouch is right. That's the impact of low liquidity manifesting as a wide bid-ask spread. It's like a hidden tax on your trades. Conversely, a highly liquid option might have a bid of $1.20 and an ask of $1.21, only a 1-cent gap.
Much better. That tight gap signifies high liquidity, efficient pricing. It minimizes that transaction friction, that hidden cost.
Precisely. So Fontania strongly urges readers, especially beginners, to always evaluate the bid-ask spread before even considering trading a particular option contract. Stick to options with tight spreads.
What's the second critical factor Fontania says to evaluate for liquidity? You mentioned contract volumes.
Yes, open interest and volume. Open interest tells you how many contracts are currently outstanding, existing in the market. Volume tells you how many contracts actually traded hands today or the previous day. Both are indicators of activity and interest. High volume, in particular, signals a densely populated marketplace for that specific option contract, that specific strike and expiration date. It means there are numerous buyers and sellers constantly active, making transactions happen frequently.
So high volume, easy entry and exit.
Generally, yes. If an option contract on, say, Apple regularly trades 50,000 or 100,000 contracts per day, you are virtually guaranteed that you can get your order filled quickly and at a price very close to the last traded price. There's always someone on the other side.
But what if the volume is really low, like maybe only 50 contracts traded all day yesterday?
That's a huge red flag for liquidity. If the volume is that thin, you might find that you are the only buyer or the only seller trying to make a trade at that moment. This gives the market makers the professionals who are obligated to provide, quotes, massive power over the price. They can widen that bid-ask spread significantly because there's no competition. You might get trapped in a position, unable to exit without taking a big loss relative to the theoretical value.
Okay, let's use that sharp U.S. example Fontanilla suggests to really illustrate this divergence in liquidity, comparing something super popular versus something obscure.
Perfect. Let's compare options on the SPDR S&P 500 ETF, symbol SPY, versus options on, let's pick a hypothetical small, niche, maybe regional airline stock. Not Southwest or Delta, but something much smaller.
Okay, SPY versus small regional air Inc.
STY is one of the most heavily traded securities in the world. Its options contracts, especially the near-term, near-the-money ones, have absolutely massive volumes, often hundreds of thousands or even millions of contracts changing hands daily. The open interest is enormous.
And the bid-ask spread.
On the most active SPY options, often just a single penny, sometimes 2 cents, it's incredibly tight. You can trade in and out with extreme efficiency, minimal friction cost.
Okay, now contrast that with our imaginary small regional air Inc.
For an option on that small cap airline stock, you might look it up and see the volume yesterday was 15 contracts total. The open interest might only be a few hundred contracts across all strikes and expirations.
15 contracts, that's nothing.
Practically nothing. And when you look at the bid-ask spread for a specific strike price, it might be $0.30 wide or $0.50 wide or even wider. Maybe the bid is $1.80 and the ask is $2.30.
So if you decide to buy it at the $2.30 ask price, you've effectively already lost over 20% of your trade value. Silver 50 cent spread, $2.30 ask, before the underlying stock even have a chance to move in your favor.
Precisely. That's the devastating impact of illiquidity. Fontanilla stresses, and it's really crucial advice for beginners. Stick rigorously to trading options on highly liquid underlying assets like major indices, SPY, QQQ, large cap stocks like Apple, Microsoft, Amazon, and ensure the specific option contract itself has high volume and a tight bid-ask spread.
Yeah.
Don't venture into the liquid backwaters until you are very experienced.
It seems like a non-negotiable rule for maintaining any kind of edge. Protect yourself from unnecessary costs.
It absolutely is. You need price efficiency to even have a chance.
Now, Fun and Neil also connects this concept of liquidity to the modern phenomenon of high-frequency trading, HFT. How does HFT fit into this picture?
HFT firms play a complex role. They use sophisticated algorithms and super fast connections to execute thousands, even millions of trades per second. Often they act as very short-term market makers, constantly placing bids and asks around the current price, trying to capture tiny fractions of a cent from the bid-ask spread over and over again.
So they're providing liquidity in a sense.
Yes, on highly liquid assets, their constant quoting activity is actually a major reason why the bid-ask spreads remain so razor-thin. Their competition forces efficiency. So, for options on SPY or Apple, HFT generally contributes to better liquidity for retail traders.
But what about on less liquid stocks?
That's where it gets more nuanced. Some argue HFT can exacerbate volatility or quickly withdraw liquidity during times of stress. But Fontanillo's main point seems to be that in the current HFT-dominated landscape, the difference between liquid and illiquid assets is starker than ever. He says spotting liquid assets can mean the difference between a quick win and a dragged-out struggle. Precisely because if an asset isn't liquid enough to attract consistent HFT market making, it becomes effectively untradeable for the average person relying on getting fair market orders filled.
So the need for that smooth execution, that efficiency, is paramount, maybe even more so today. It sounds like a core theme echoing through modern finance generally, even into areas like decentralized finance, DeFi, where speed and low friction are always major goals.
Very much so. The underlying principle is the same. Efficient markets require liquidity. Fontanilla makes it clear that understanding and prioritizing liquidity isn't just a minor tip. It's an essential factor for survival and success in options trading.
The ultimate takeaway from this chapter feels very practical then. Even the most brilliant strategy or accurate forecast means absolutely nothing if poor liquidity eats away all your potential profit during execution. Efficiency isn't optional, it's paramount.
It absolutely separates the theoretical trader, the one practicing on paper, from the practical trader who has to navigate the real market with real money. If you can't consistently get a good, fair price when you enter and exit, you simply can't make money in the long run, period.
A sobering but vital lesson. Check liquidity first. Always. Like, subscribe, and share for more update, and continue to next. All right, we've covered a ton of ground. We've defined options, priced them, managed risk, learned strategies, and focused on liquidity. Now we arrive at the climactic close, Chapter 6. Fontanilla dedicates this final chapter less to new mechanics and more to mindset and methodology. He really emphasizes that all the technical knowledge we've discussed is, well, almost useless without building a personalized, disciplined approach. And the two watchwords he highlights are patience and practice.
Absolutely. This is where it all comes together. Fontanilla argues that it's this combination, patience and deliberate practice that ultimately transforms those initial novice jitters, that fear and uncertainty, into what he calls seasoned confidence for long-term wealth. The knowledge is the foundation, but the application requires a unique approach tailored to you.
So it's not just about learning the rules, but learning how to apply them consistently, personally over time.
Precisely. And the book's final core mandate for beginners is incredibly simple, yet often ignored. Start small. Commit to risk management, not just as a rule you learned, but as an ongoing process. Fontanilla really stresses that beginners must start by allocating only very small amounts of capital they can genuinely afford to lose without emotional distress. And they should stick to lower risk strategies until they can prove proficiency. And maybe even more importantly, until they demonstrate emotional neutrality, the ability to handle both losses and gains without getting overly fearful or greedy.
Starting small, staying emotionally level. Makes sense. Does he single out any specific strategy as being particularly good for this initial phase? A good place to dip your toes in.
He does. He points to the covered call strategy as being almost the perfect entry point for many beginners, especially those who already own some stocks. Why? Because it's income generating and inherently more conservative than many other options strategies.
Okay, the covered call. We touched on selling options briefly. How does this one work, and why is it considered lower risk?
The covered part is key. It means you already own the underlying stock at least 100 shares for every call contract you intend to sell. Let's say you own 100 shares of a relatively stable, dividend-paying U.S. utility stock, maybe Consolidated Edison, ED, currently trading at $70 per share.
Okay. Own 100 shares of ED at $70.
Now, you execute the covered call strategy by selling a call option against those shares you own. You might choose a strike price that's slightly above the current market price, say with the $75 strike call, and maybe choose an expiration date about a month out. Let's imagine you can sell that $75 call option for a premium of $1 per share. Since the contract covers 100 shares, you immediately collect $100 in cash premium, $1 by 100.
Okay, so I get $100 up front just for selling the call. What's the appeal beyond the immediate cash?
Well, that $100 premium is yours to keep no matter what, effectively lowering your cost basis on the stock you already own. Now, two main things can happen by expiration. Scenario one, the stock ED stays below the $75 strike price. Maybe it stays flat at $70. Maybe it goes up to $74. Maybe it even drops a bit, as long as it's below $75 at expiration.
What happens?
The call option you sold expires worthless. The buyer won't exercise their right to buy at $75 when the market price is lower. So you simply keep your original 100 shares of ED, plus you keep the $100 premium you collected. You've generated extra income from your stock holding.
Nice. Extra yield on the stock I already own. What's scenario two?
Scenario two. The stock price rises above the $75 strike price by expiration. Let's say ED rallies to $78.
Okay.
Now, the buyer of the call option will exercise their right to buy your shares from you at the agreed-upon $75 strike price. You are assigned on the option. You are obligated to sell your 100 shares at $75.
So I lose my shares. Is that bad?
Well, you do have to sell your shares, so you miss out on any gains above $75. In this case, the move from $75 to $78, that's the trade-off. But think about what you achieved. You still profited from the stock's appreciation from your original $70 price up to the $75 strike price, a $5 gain per share. Plus, you still keep the $1 per share, $100 total premium you collected when you initially sold the call. So your total profit is $5 stock gain plus $1 premium equals $6 per share or $600 total. You achieved a solid return, albeit capped.
Okay, so the risk in a covered call isn't really about losing more money than owning the stock. It's about potentially capping your upside gains if the stock takes off dramatically.
Exactly. The primary risk is opportunity cost on the upside, or the same downside risk you already had by just owning the stock. If it falls dramatically, the small premium you collected offers only minimal protection. That's why Fontanilla presents it as such a good starting point. It's an easy, relatively low-stress conceptual bridge from simply owning stock to actively using options to generate income and potentially reduce volatility. He calls it a strategy for generating mailbox money, aiming for consistent, smaller gains, perfect for building confidence before tackling those higher leverage, higher risk directional trades like the vertical spreads we discussed earlier.
So the path Fontanilla lays out for scaling up isn't about rushing into complex strategies after one win.
Yeah,
It's about proving proficiency consistently at the lower levels first.
absolutely. Patience and process. Fontanilla explicitly warns that perhaps the greatest danger for a new trader after experiencing some initial success is hubris, getting overconfident, thinking they've cracked the code, and then scaling up too quickly or moving into much riskier strategies.
Like maybe moving to selling uncovered or naked options.
Exactly. Strategies like naked puts or naked calls have undefined risk and can lead to catastrophic losses if the market moves sharply against you. Fontanilla advises only gradually increasing contract size and only considering more complex strategies like maybe iron condors, butterflies, or yes, eventually maybe even naked selling if appropriate for very advanced users. After you have demonstrated consistent profitability with smaller size and simpler strategies over many market cycles, including adverse conditions, you need to prove you can handle drawdowns without panicking. The market ruthlessly demands patience and discipline.
This whole personalized, patient, start small approach. It really seems to resonate strongly with the broader trends Fontanilla mentions for, say, 2025, focused on self-directed investing. More people are taking control of their own portfolios, looking for ways to participate actively.
Yes, and particularly in an environment where maybe economic recovery is ongoing but still uncertain, people are looking for strategies that allow them to participate in potential growth without being fully exposed to the risk of another major crash. Options, when used responsibly within a personalized plan, offer exactly those kinds of tools.
So the final mandate from Fontanella for you, the listener, is clear. Take the book smarts, the definitions, the Greeks like delta, the structure of spreads, the importance of liquidity, all the things we've unpacked in this deep dive.
Yes, absorb that knowledge.
And then blend it carefully with real market trials. Start small. Use minimal capital. Practice diligently, track your results honestly, learn from mistakes.
It's that careful, iterative combination of theoretical knowledge and practical, patient application that Fontina believes is the only reliable way to achieve long-term success, maybe even build towards that generational impact he mentions. Options aren't a get-rich-quick scheme. They are sophisticated tools for building and preserving wealth when managed responsibly. They give you a degree of control over risk and potential reward that simple buy-and-hold investing often can't match, especially during periods of high volatility.
It truly sounds like the journey Fontina maps out is one from being a passive hopeful, just buying stocks and crossing your fingers,
To becoming an active, informed risk manager using these tools strategically.
practice and patience. The final keys. Like, subscribe, and share for more update and continue to next. #tag outro.
So, just to synthesize our pretty comprehensive deep dive today, guided by Woodley Fontina's Options Trading Simplified for Beginners, we really moved methodically through the key concepts. We started by defining the foundational contract in Chapter 1, focusing on that crucial difference between having the right versus the obligation. Then we moved to accurately pricing that contract in Chapter 2, looking at intrinsic and extrinsic value, and highlighting the critical importance of understanding the Greeks, especially delta.
Right, the sensitivity and probability.
Exactly. Chapter 3 was all about establishing the foundation of options safety, detailing how your maximum loss is capped when you buy options, providing that defined risk. Then in Chapter 4, we deployed some structured, defined risk strategies like vertical spreads, showing how to align trades with specific forecasts.
Manage risk more tightly.
Precisely. Chapter 5 brought in the practical necessity of market efficiency, focusing on liquidity, the bid-ask spread, and volume. And finally, here in Chapter 6, we landed on the importance of building a personalized, patient, low-risk approach to start, maybe exemplified by the covered call strategy before scaling up.
The core benefit through all of this, it seems to me, is building confidence. This deep dive using Fontina's framework hopefully provides you, the learner, with a kind of shortcut through all the usual complexity and jargon. It should arm you with the language, the concepts, and the critical framework needed to start engaging with this market more responsibly.
Well said. You should now understand that the real power of options, when used correctly, lies in their incredible flexibility and, maybe most importantly, that structural ability they give you to actually dictate your maximum financial exposure before you ever commit a single dollar of capital to a trade.
Which leaves us with this final provocative thought for you to mull over, something building directly on those concepts of bounded risk and defined strategies we've discussed. If the options market truly allows you to define your absolute worst-case scenario, your maximum loss before you even place a trade, does that potentially make certain option strategies inherently safer than simply buying and holding a stock, especially when the market tanks unexpectedly? Think about the difference between a known, quantified risk versus an unknown, potentially unlimited downside risk. It's something to really consider as you continue your learning journey.
Definitely food for thought. We really encourage you to take these concepts, start small, pay close attention to those Greeks and liquidity, and always apply the knowledge with discipline and patience. Thank you so much for joining us for this deep dive into options trading today.
Yes, thank you for tuning in. We hope this was valuable, and we'll catch you next time on Book Podcast Zone.